In the next several videos, we address nuances having to do with the equity method of accounting. The first thing that we address are deferred taxes that are created as a result of affiliate income that's recognized on the investor's income statement. The investor receives a cash return on its affiliate investment in one of two ways. The first is via dividends, and the other is selling the investment outright. So those are the two primary ways in which you can actually get a cash return on your affiliate investment, where you own 20 to 50% of the other business. Under both circumstances, taxes are going to have to be paid. Dividends are taxed at a low rate, and gains on sale of affiliate investments are fully taxed at the corporate level. In terms of the reason the dividends are taxed at a low rate, it has to do with something called the dividends received deduction. In an effort to alleviate investors from a triple tax, and if you think about what's happening when a company takes on a significant investment in another company, they're really potentially facing three taxes. First, on the actual affiliate level. So let's say you own 25% of another business, and that business in and of itself has had to pay a first corporate level of tax. Then you pay on your corporate level. And then lastly, on the investor's shareholder level. If that income is distributed finally via dividends, you have to pay on the shareholder level, capital gains tax. As a result of that, there is a dividends received deduction, which enables a large portion of affiliate dividends to be exempt from taxation. Currently, 80% of dividends that are received from an affiliate are tax-free. Tax only applies on the remaining 20%, and as such, the total tax on dividends at the corporate tax rate of 35% is only 7%. While the timing of when the investor pays the cash taxes depends on the timing of when the dividends or the sale of the investment actually happens, GAAP requires that income from affiliates be taxed when it's earned, and that's the accrual concept. So we've been going through exercises where we're recognizing income based on our proportionate share of the affiliate's net income. That's the accrual concept of accounting. It doesn't necessarily, as we've talked about in prior videos, have to coincide at all with when the dividends from that affiliate are actually provided or when the sale of that investment is finally made. As a result, there is now a timing difference between book and IRS taxes. The IRS will only tax you when the dividends are actually received or when you sell the investment, whereas from a book standpoint, you are recognizing taxes every time based on the net income, the accrual-based net income that the affiliate generates. As a result, a deferred tax liability is created when the company records income in affiliates. The deferred tax liability is reversed whenever dividends or sale proceeds are received. One thing to point out in terms of the deferred tax liability that's created is if the company assumes that the distributions come in the form of dividends eligible for the dividend received deduction, you're only going to have to pay a smaller amount which reflects the dividends received deduction in the future. So specifically, whatever the affiliate income is, times 1 minus the dividends received deduction, that 80%, times the tax rate. If no dividends are expected and rather the only taxable event that's expected to take place is upon the sale of the investment, then the DTL will be calculated simply as affiliate income times the tax rate. So let's assume for a moment that we have the same exercise that we had gone through in the prior video. The only difference is in this case the affiliate issued no dividends. We're trying to create a simplified example here that we're going to relax in just a moment. So same exercise, the investor generates their own income statement with revenues of 1,000, expenses of 600, therefore pre-tax income of 400. But of course they also recognize this affiliate income of 37.5, which is a function of the affiliate net income and the fact that we own 25% of that. Now, assuming the investor expects to recover all of its investment gains via future dividends as opposed to a gain on sale, the book taxes recorded by the investor will recognize deferred taxes equal to the equity income of the affiliate multiplied by the tax rate adjusted by 1 minus the dividends received deduction. So let's break up taxes into the several components. First is the taxes associated simply with the income of the investor. The investor is expected to generate pre-tax income before we factor in any affiliate income of 400, and let's assume this is cash revenues and cash expenses. So we're looking at a 35% tax rate times 400. We're looking at 140 in taxes. And of course, since these are cash revenues and cash expenses, let's also assume that that is the exact obligation that's due current to the IRS. But in addition, we have to wrestle with this affiliate income. And we've just identified that the company expects to recover this income as an investor via dividends in the future as opposed to an outright sale. Which means when you calculate the taxes that have to be recognized by the investor for its income in the affiliates, we're going to do this calculation off to the side. The taxes there, the GAAP taxes recognized. So let's identify that these are GAAP taxes recognized. It's going to be recognized as 37.5 times the tax rate times 1 minus the dividends received deduction, which is 20%. 1 minus 80% is 20%. And that equals 2.625. Note that this is recognized as the additional tax for GAAP purposes that has to be recognized in addition to the investor's taxes, or I should say the taxes associated with just investor income. This is the taxes the investor has to recognize associated with affiliate income, but they're not going to have to pay during this period that amount of tax to the IRS because the IRS only cares about when the dividends are received. So right now you don't have to pay any incremental cash taxes beyond the 140. Instead, you recognize deferred taxes of 2.625. So if we were to break out this line item into what's current versus what's deferred, this is what's current and this is what's deferred. So the total for net income that's recognized for book purposes becomes 294.875. So here's what we're going to do. We recognize now, so this is very similar to what we did in the prior video, which is to adjust the balance sheet to reflect this net income. So the first thing, let's go with the easy stuff. First, we know that net income, or the equity, goes up by the 294.9 or 875, let's just round up. 294.9 in net income. So we know that. What's happening to cash during the period? Well, assuming revenues and expenses are cash, assuming we receive no dividends during the period, so what we put in our pocket is 400 and then we owed 140 to the IRS. So the only thing that's actually going into our pocket is 260. And keep that in mind. That's the only thing that's happening to cash. It's the cash revenues minus cash expenses. Affiliate income is non-cash income. The only cash you receive from your affiliate investment is dividends or if you sell the asset. And then, of course, cash taxes you have to pay. Deferred taxes is an accounting adjustment. So 260 is what's actually debiting cash. So where's the remaining 34.9 to make debits equal credits? Well, your affiliate investment has grown by 37.5 by the income. Remember, affiliate investment itself grows by the affiliate income and is reduced by the recovery of that income via dividends. So here we simply have a growth of 37.5. But the final adjustment is the recognition now of a new deferred tax liability in the amount of 2.6. And this is how we make this balance sheet balance. At this point, debits all equal credits. If you add these two together, you're going to get exactly 297.5. Since the affiliate income increased the value of the investment, as we saw in the prior slide, you see we increased the value of the investment from 100 to 137.5. The investor should expect to see this benefit either in the form of dividends down the road or a gain on sale in the future. Since in this example, we're assuming that the investor expects this benefit to be fully captured in future dividends, the DTL is created to reflect that ultimately the investor will owe cash taxes on the dividends received. For simplicity, let's actually see how this plays out. So for simplicity, let's assume that in 2016, the affiliate reported no income. So in the next year, no income has been reported, but rather the affiliate is issued dividends in the amount of 37.5 million, exactly recovering the amount of income that the investor recognized in the prior year. And the reason why we're making this so simple is we're just saying, okay, so you generate all your income in one period, which is when, for book purposes, you recognize the deferred taxes. And then in the next period is when you actually receive all of that income distributed back to you as an investor. Just so we can see how deferred taxes are created and then ultimately reversed. Just to highlight the idea that this really is a temporary timing difference, just like all deferred taxes are. So here, 2016, it's the next year. The affiliate has reported no income. Just again to clarify what's going on. The affiliate has issued $150 million worth of dividends. We own 25% of that, so we are going to get $37.5 million in dividends coming our way. Of course, with the dividends received deduction, we are going to have to pay $2.6 million on that $37.5 million that we are going to recognize. Again, the reason why we are going to have to pay cash taxes to the IRS on our dividends is because we are going to get 37.5. Notice, by the way, this 37.5 that we are going to get from this represents, we own 25% of that 150, so, which means we're going to get 37.5. Notice that doesn't appear anywhere on the income statement. It's only when the affiliate generates income that you recognize that income on the income statement. The fact that you're getting dividends doesn't actually show up on the income statement at all. Again, that's the accrual concept. But what is happening is that because now 37.5 at an 80% DRD adjustment and at a 35% tax rate means you're only going to have to pay cash taxes of $2.6 million. Now, even though you only, from a GAAP perspective, only owe or recognize taxes of $140 million, the actual cash taxes you pay is that $140 plus the extra $2.6 associated with those dividends that you receive. The way that that's accounted for is via the reversal of the deferred tax liability. You see, you have cash taxes of $142.6, but you subtract $2.6 to get to that $140, and this $2.6 represents the reversal of deferred taxes. So your net income doesn't have anything to do with what you see from a GAAP perspective, has nothing to do with these adjustments. These are taking place behind the scenes. And so the net result on the balance sheet is on year one, we see the adjustments that we had made where you recognize retained earnings, which captures all the affiliate net income. The value of the investment goes up from 100 to 137.5. The deferred tax liability is created in anticipation, and in the future you will have to pay taxes on dividends. The next year, all of it is fully reversed. The entire amount of income is recovered in the form of dividends by you, the investor, bringing your investment carrying value back to 100. Any income generated while you've held the investment has now been essentially given to you in the form of cash dividends. And the deferred tax liability is reversed because you've actually gone and had to pay the $2.6 million.